Hey everyone, Coach Investor here with the second part of the FinTech recap preview for 2024. The first part will be in the top right corner. We talked about PayPal, Affirm, New Holdings, and StoneCo, what happened in 2023, valuation, financials, and expectations for the years to come. Same thing will be done in this video, SoFi, Block, Robinhood, dLocal, as well as Adyen. So sit back and relax. First company we're going to look at is SoFi Technologies. Now, unfortunately, SoFi did not finish above $10 for 2023. It finished just below that, and you will see that the $10 was a resistance in July as well. Now, currently, the company has a market cap of $9.54 billion. It's up 115.84% in 2023, has a forward PE of 84.1 times. Of course, not cheap when you look at this metric, but this company is just becoming profitable. Q4 is expected to be the first GAAP net income profitable quarter for the company, and I think we should be getting used to that for next year. Now, with regards to the analysts' expectations, estimates for fiscal year 2023, sales growth of 33.3% year over year. EPS is expected to be a loss of 10 cents. This is for fiscal year 2023. Then in fiscal year 2024, sales growth of 22.5% and EPS to be 9 cents. Now, going into fiscal year 2025, sales growth of another 17.8% year over year and EPS to be 25 cents, which means close to 200% year over year growth. If we look at the analyst price targets, the average price target sits at $9.59, which represents a downside of 3.58%. Now, to show you how early days we still are with SoFi, stock goes on X posted this. So in Q1 2022, SoFi had $2 billion in assets and sat at number 449. 18 months later, SoFi sits at the 80th spot and has $21.5 billion in assets. We also know that Anthony Noto expects SoFi to become a top 10 US institutional financial institution in the years to come. Whenever that will happen, I don't know. But the fact that they've grown so fast in just 18 months is pretty impressive. And now we are entering the profitable chapter of that company. Now, profitable does not mean that suddenly it will not grow anymore. No, as we've seen, this company is still growing quite fast. It's still growing many businesses quite fast. I think 2024, we're going to see some improved growth when it comes to the technology side of things, Galileo, Technisys. I think 2023 was a year of integration, partnership, relationship building, stuff like that. In 2024, I think we're going to see some lucrative results. I mean, it's pretty remarkable how well this company has been doing despite operating with, let's say, a hand, two hands tied behind their backs after the student loan pause. I mean, that was the bread and butter of the company, right? Before. Now, they've grown into something that is much bigger than that. It's pretty impressive. Now, looking at the graph right here, as I said, $10 was rejected. It has been rejected already at the end of July. The 200-day moving average sits at $7.81. RSI, we are high, but not overbought. This is on the weekly. Now, previously, when we got rejected at $10, we went all the way back down to around $7 or so. That was a nice little support line. Now, I don't think we're going to make our way all the way back down to $7, but maybe expect a little bit of a pullback. I mean, going up so much in a short period of time is not that healthy. Having a little pullback is fine, especially for long-term investors. Now, before going into company number 2, if you enjoy this type of videos, leave it a thumbs up, subscribe if not, we'd really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. And of course, do share your picks for the fintech sector for 2024. Now, company number 2 is Block, previously Square. Market cap $47.77 billion, closing the year at $77.35 a share. Has a forward PE of 27.5 times. Year to date, it's up 23%. Now, as you can see here, PE in the next 12 months, EV to EBITDA, price to sales, all sit well below the 5-year mean for the company. And the same can be said for price to free cash flow, although that's in the last 12 months. Now, the problem with Block has never been top line growth, right? I don't think that was the problem. The problem has been profitability, the bottom line. Now, with recent announcement that they've made, they are finally getting costs under control, or at least leaning towards going that way. There's still a lot to do, but I mean, this company should increase its free cash flow, which should help with share buybacks, which was announced as well. Now, what are the analyst expectations for the coming years? Well, you can clearly see here that the bottom line will outgrow the top line for the coming years, and that's great in my opinion. For fiscal year 2023, sales is expected to increase 24.12%, EPS to increase 91.82%. Fiscal year 2024, sales growth of close to 13%, the same for fiscal year 2025, by the way. Then with regards to EPS, that is expected to grow close to 54% year over year in fiscal year 2024, and then another 31.6% in fiscal year 2025. So it's definitely becoming more and more profitable in the coming years, or at least that's the expectation. With regards to the analyst price targets, it's basically at the same price we're at right now, $76.45. It's a downside difference of 1.17%. Now, if we look at the graph, I mean, you're going to see these V-shaped recoveries on a lot of stocks, especially starting in October. We've seen that in the past video as well. This has also been the result of getting a positive signal from the Fed when it comes to interest rates and their probable cuts in 2024. Now here as well, if we zoom out, we can see that previously $80 was some kind of resistance. I mean, I think we were just over for half a minute or so over the $80 mark, got rejected there. So it might be a short-term top right now. If we look at the 200-day moving average, that sits closer to $60 at $62, $63 right now. I'm not saying we're going to go that low, but just bear in mind that the RSI is also pretty high, not overbought on the weekly. So we might be due for a little pullback. Again, this is extremely healthy. You don't want to see these types of things continue, because then you get this type of scenario, which we have to zoom out quite a lot. This huge mountain and then a huge crash, because this is not sustainable. Up next, fintech stock number 3 I want to talk about is Robinhood Markets. Of course, some love it, some hate it. Fine. Currently, it ended the year at a market cap of just over $11 billion, have a forward PE of 33.7 times. Year to date, it's up 56.5%. The shares are now at $12.74. Now here, with regards to the analyst expectations for fiscal year 2023, sales growth of 34.4%, EPS 35 cents. Fiscal year 2024, we can see that the bottom line here is also outperforming, 24.22% EPS growth year over year, top line sales growth of 9.74%. In fiscal year 2025, sales growth a bit closer to 4% and EPS closer to 8%. Here, if you look at the analyst price target, the average sits at $11.61, which represents close to 9% downside. And here as well, if we look at the graph, you can clearly see that since the same time, basically end of October, beginning of November, this stock has gone up quite fast. But right now, we're sitting in an area where previously as well, we were rejected closer to $13 back in November 2022, back in the summer of 2023. And right now, well, this week we were over $13, but clearly we ended the week here in the red. Let's see what happens. If we can maybe form a little base here, that would be nice. The 200-day moving average sits closer to $10. RSI here is also pretty high. You're going to see, we've seen this trend already with a lot of fintech stocks. Now, with regards to Robinhood specifically, I do want to add some extra information here, and this comes from their latest, this was Q3 earnings report. You can clearly see here that right now they are making a lot of money. Well, the majority of their revenue comes from net interest revenues, then transaction-based revenues, and then other revenue. Now, some might say, yeah, but if you expect rate cuts in 2024, isn't that going to hurt net interest revenues? Yes, it's maybe going to be a bit lower. But remember, interest rates are still going to be high. Plus, if interest rates come down, if there's more bullish sentiment in the market, which is what we've seen more recently. Transaction-based revenue usually goes up, as you can see here back in 2021. Now, that's not all. This company has clearly evolved over the years. It's not just about crypto. It's not just about equities or options or whatnot. You have retirement accounts, you have cash sweeps, gold memberships. I mean, you can really see the numbers. This is from November here. For crypto, we know that we are in a, let's say, semi-bull market right now. So total trading volume for crypto have increased 74% month over month. Should definitely help that segment of the business, which was a bit, not a bit, but it was down and didn't really do much for Robinhood in the last couple of quarters. Some big boosts right here. Then with regards to total cash sweep, gold cash sweeps is up 10% month over month and 272% year over year. This is a company that is offering many new things, many things that improves its bottom line as well. It has launched Robinhood Crypto in Europe, so that should definitely help them. Plus, the launch of Robinhood in the United Kingdom will definitely give them some tailwinds in 2024 and onwards. Up next, company number 4 is a company out of the Netherlands, and that's Adyen or Adyen. Adyen currently, this is by the way, the stock on the Amsterdam Stock Exchange, so that's 1,169 euros. Market cap of 36.28 billion euros with a forward PE of 51.9 times. Year to date, it's still down 9%. I mean, still down. Year to date in 2023, the stock is down 9% because the year is over when it comes to the stock market. I know what most are saying, 51.9 times, very, very expensive. Yes, it's expensive, but as I said, when the stock crashed 50%, it was trading at 29 times. And even then, people were saying it is pretty expensive. Well, quality companies like this usually trade at a premium. Now, why did we see such a recovery? Well, it's because they gave investors a business update, something that they usually don't do because this is a company that reports twice a year, first half of the year and second half of the year. This time, because, well, the stock took a major hit, 50%, they decided on November 8th, I believe it was, they decided to have sort of a investor day business update where they provided a lot of information of how they're doing right now, which was Q3, and their expected growth rates, cost cuts, and stuff like that for the coming years. I'm going to check that out in just a second. Now, currently the average analyst price target sits at 1,100 euros, which is 5.88% lower than the price we're at today. As for the analyst expectations for the coming years, sales growth above 20%. Then with regards to EPS, fiscal year 2023, one of the reasons why the stock also got hit is, well, EPS is only growing 10% year over year. But fiscal year 2024, the expectations is growth of 24.6% year over year. And then in fiscal year 2025, another 30.6% growth. Now, if we look at the financial objectives that they gave us, so net revenue growth, they aim to grow net revenue annually between the low 20s and high 20% up to and including 2026. EBITDA margin, they aim to improve EBITDA margin to levels above 50% in 2026, and they expect to benefit from operating leverage inherent to their business model. They also said here with regards to hiring, as always, we spend significant time preserving our high talent standards and company culture through our extensive interview process and onboarding program. We are now deliberately and gradually slowing down. Previously, throughout 2023, they had the luxury actually because they were financially stable, still growing, still executing quite well. They had the luxury to not do many cost cuts, not do many layoffs, should I say. They went out there and started to hire quality talent. Yes, they took a hit in the short term, but this is going to help them in the long term. Quality companies, strong companies that survive tough times usually come out of those tough times much, much stronger. This is exactly what is happening and what is happening with Adyen right now. Then with regards to the graph here, as you can see, if you remember Stonko has approximately the exact same reaction, went up close to 90% and then dipped a little bit. Right now, same has happened with Adyen. We bottomed at around 645 euros, went up, which was, like I said, 90%. Now we're going a bit lower. Let me remove that. A bit lower. Maybe we're going to go to the 200-day moving average, which is just 30 euros lower. Now, last company is dLocal. A subscriber asked me during the live stream to add it to the video. So here we are. dLocal market cap, $5.12 billion. Has a forward PE of 24.6 times. Year to date, the stock is up 13.62%. Now, as you can see here as well, PE, EV to EBITDA, price to sales is lower than the 5-year mean, and the same with price to free cash flow, but that is the last 12 months. As for the analyst price target for the next 12 months, the average sits at $19.96, which represents an upside of 12.82%. As for the analyst expectations here for fiscal year 2023, sales growth of 52.27%, EPS growth 55.32%. In fiscal year 2024, sales growth of 38.48%, with EPS growing another 36.11% year over year. And then in fiscal year 2025, they're reaching sales over $1 billion, so that's growing 31.26%, and EPS growing 30.3% year over year. So again, tremendous growth here, top and bottom line. Remember, Mercado Libre's CFO has joined dLocal as co-CEO. There was a whole story around dLocal, whether there was maybe some shady business going on there, but that has been debunked. The stock didn't really do that much compared to others out there. I mean, it's still up 13% in 2023, but it isn't that much comparing to other companies in that sector or the overall tech market. If we look at the graph, it basically now sits just over the 20, the 50, and the 200-day moving average. RSI is still pretty neutral. You're probably asking yourself, what the heck happened here? Well, this was the earnings report back in August, which was a great earnings report, basically debunked the whole bear case story. So you got a huge jump there, but couldn't stay at those prices. So now we're sitting at around $17.69, which in my opinion, this could be one of those candidates that will probably outperform in 2024. So that will be it. That's the last video also for 2023. I hope you enjoyed it. Again, part 1 will be in the top right corner. Do share your thoughts with regards to all the companies covered in these videos down in the comments below. Thank you everyone for all your support in 2023. Let's make 2024 an even better year. So as always, if you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one and next year. Bye-bye.